Welcome to the Everything Financial Radio Show. I'm your host, Dennis Tubbergen. This is the Legacy Radio Network. We have a great show lined up for you this week. Best-selling author and economist, Mr. Harry Dent, will join us momentarily. We'll also talk about the massive amount of gold buying that's been taking place in China. Does that telegraph a hard economic landing for China? Mohammed El-Arain, the CEO and co-chief investment officer of one of the world's largest bond investment companies, has said this past week that the world's economic future rests on a knife's edge. We're going to talk about his comments as well as get Mr. Dent's comments about what's going on in the economy as well. Really looking forward to that interview. Also, I want to remind you, if you have not yet requested a copy of our 2012 Market and Economic Outlook Home Study Kit, you can go to investingapproach.com and request that. In the Home Study Kit, you'll receive our 2012 Market and Economic Outlook Report, a CD containing an interview with financial analyst and commentator Ian Gordon, who you've heard right here on the Everything Financial Radio Show, and you'll also get a copy of my book, Economic Consequences: Can You Survive, Even Prosper from the Results of 100 Years of Bad Money Decisions? Go to investingapproach.com. Let us know where to mail that, and we'll be glad to do that. Also, if you would like to attend a discovery group, you could go to personallegacyseminars.com. All new content for 2012. We'll talk about why we believe the current economic winter season in which we find ourselves was entirely predictable. We'll hear more from Mr. Dent on that momentarily. What lies ahead and what it might mean for you and your family. We'll also tell you why we believe that most of the economic growth of the past 30 years has been an illusion and what the consequences might be for you and your money. There's more information posted at personallegacyseminars.com. We will be at the Hilton in Grand Rapids on February the 14th, down in St. Joe on the 15th, and over in Montague on the 16th of February. So go to personallegacyseminars.com to get more information. I'm very privileged to have with me today on the Everything Financial Radio Show Mr. Harry S Dent, Jr. Mr. Dent is the president and founder of HS Dent, which publishes the HS Dent Forecast and the HS Dent Perspective and oversees the HS Dent Financial Advisors Network. He's the author of the New York Times bestseller, The Great Depression Ahead, published in 2008, as well as The Great Boom Ahead, published in 1993, in which he stood virtually alone in accurately forecasting the unanticipated boom of the 1990s. Mr. Dent is a Harvard MBA, a Fortune 100 consultant, new venture investor, and noted speaker. We're very happy to have on the show today Mr. Harry Dent. So, Harry, welcome to the Everything Financial Radio Show.
Oh, nice to be here, Dennis.
Harry, I'd like to jump right in. You utilize demographics in your economic forecasting, and a lot of our listeners may be unfamiliar with that process as you have really pioneered it. Would you explain to our listeners what demographic forecasting means, and could you give us an example?
Yeah, it's unfortunate. Economists have just deliberately ignored this because it's not something they study, but demographics is something that's very predictable, well in the future, and it's something that people can understand. The best example is our simplest and most powerful indicator, which I came up with in 1988, called the spending wave. It's just a 46-year lag on the birth index in the United States, and of course we can do this in any country, for the peak in spending of the average family. The average family peaks in spending at age 46, kind of plateaus into 50 as their kids continue to leave the nest and graduate from high school or college, and then spending drops off dramatically from age 50 forward as people are saving for retirement and then retiring and spending down those savings. So that 46-year lag, for example, the rising birth index for the baby boom in the U.S. was 1937, and it peaked in 1961 before dropping off. You add 46 to that rising birth wave, and you get a boom from 1983 through 2007, and then a slowdown. We predicted this downturn in the economy 20 years ago in the late 80s. We said, around 2008 forward, we'd be entering an extended downturn that'll be deflationary, unlike the 1970s, and more like the 1930s, so i.e. a depression. So that's just one example. We can correlate young people entering the workforce versus older people retiring. That's the best correlation with inflation, because young people are expensive to raise and incorporate in the workforce, and older people kind of like downsize everything as they prepare for and retire. So, we can predict when when grocery stores are going to expand in different counties, or potato chips, all types of spending. When people buy their first home, their trade-up home, their vacation home. So, I mean, we saw the housing bubble peaking in 2004-05, right as it was peaking, because home buying peaks before the overall peak in the economy that comes, 4 or 5 years later. So it's a very powerful tool, and it allows people to see the key economic trends that will impact their lives, their businesses, their investments over the rest of their lifetime. And economists have no clue, and politicians have no clue right now. Nobody understands that 92 million baby boomers are going to be saving, paying down debt, spending less, no matter what the government does. So that's why one of the big reasons the stimulus keeps pumping up the economy for about a year, and then it just falls right back down. So nobody has a plan for dealing with the massive private debt, which is far bigger than the public debt that everybody else worries about. So nobody's really in reality, because they don't understand total debt and they don't understand demographic trends, and both of these are crystal clear.
I'd like to follow up on a couple things you said there, Harry, because the policy response by the Federal Reserve has been quantitative easing, or essentially money printing. That has many forecasters predicting inflation, but you made a comment that you believe the period of time in which we find ourselves is going to be more like the 30s, which was deflationary. Could you expand on that view and why you think we're not going to see inflation?
Yeah, this is another simple principle which history is crystal clear on. Every time you have a major debt and credit bubble, like we just saw in the last few decades, and especially from 2000, 2008, by the way, and no economist is telling you this, private debt mushroomed from $20 trillion to $42 trillion between 2000 and 2008. In just 8 years, we more than doubled all the debt we've accumulated since the country began hundreds of years ago. In 8 years, and nobody's talking about this. Everybody's worried about the federal debt, which is bothersome. But what history shows, when you have a debt bubble like that, you also have a bubble in stocks or real estate or whatever assets, the flavor of the time, and in this case, all of them, commodities, stocks, real estate, all bubbled up and in successive bubbles. And when that debt gets restructured and written down, which it inevitably does, and when those asset bubbles deleverage or deflate, you get deflation in prices. You are creating money. The Federal Reserve, only in emergencies like QE1 and QE2, creates any substantial money other than currency. The banks create money and financial institutions. And so again, when that is the deleveraging of $42 trillion in debt that is going to outweigh the continued increase in government debt. Government is going to run deficits, and if the economy gets worse like we see ahead, the deficits are going to be even higher. But $42 trillion in private debt is, almost 3 times the size of the public debt at $15 trillion. So it's the private debt that is deflating. It's the government debt that's inflating. Since most economists and analysts are only looking at the government debt, they see inflation, and that is inflationary. They don't see the private debt deleveraging. In the last few years, government debt has gone up about $5 trillion. Private debt has gone down about $4 trillion. In a deeper downturn, like late 2008, that private debt would deleverage much faster, and you're going to end up having deflation, and we actually had deflation in late 2008. So the Fed is fighting deflation. So that tells you the trend. The Fed is desperately trying to inflate to keep the financial system from collapsing and keep prices from collapsing, which causes a depression. Well, you have to delever that debt. It's a good thing to get rid of $20-some trillion in debt. It's a good thing for home prices to come back so young families can afford the American dream again. It's a good thing for health care and private education costs to come down. They've been in the stratosphere forever. So a lot of good things came out of the Great Depression. We became the strongest economy in the world after that. And it paid off for decades, but it does take some pain. You do have to get off the debt habit. We're like a drug addict since the 1970s, borrowing. We've had public, government deficits, trade deficits consistently, and private debt since the early 80s, growing at almost 3 times the rate of the economy. You can't keep doing that. So the government is stimulating to keep this bubble from bursting. The truth is we need this bubble to burst if we're going to get back to the American dream again, and so the government's doing everything but that. And the Republicans and Democrats, neither of them are even close to a solution.
Well, certainly I think a lot of listeners would agree with that. And Harry, in about the 3 minutes we have left on this segment, I know your comments here are probably depressing some of our listeners that are hoping for a more vibrant and certainly quicker economic recovery. Based on your forecasting methods that you've described, what do you see for the economy and the stock market? How long does this downturn or this deflationary period last, and at what point do we start to see a recovery?
Well, first of all, we could be coming out of the worst of this by 2011-12. Like in the Great Depression, we got rid of most of our private debt in 3 years, but we're not doing that, so they're pushing this off. I think the crisis is going to hit the second time, deeper between 2012 and 14. The biggest question in our forecast, does the government come up fast enough with a QE3 to push this down the road maybe one more year? But I think in the next 3 years, the government can't keep fighting this. It's too big a wave of retirement, demographic trends down and debt deleveraging. But since there's been a flight of capital out of Europe into U.S. bonds, it has given the Fed more ability to stimulate here without being penalized with higher rates like in Europe. So I think you could see the economy start to slow mid this year, stocks start to crash again, but the Fed comes in with a QE3 and we get a rally in an election, and then we get a bigger downturn 2013 and 14. That'd probably be my best forecast at this point, but 2012 and 14, it's better to be safe and more defensive. After that, there'll be great investment opportunities.
We are chatting with Mr. Harry Dent, and our conversation with him will continue, and Everything Financial Radio returns. Stay with us.